Alright guys, today is Monday the 24th, 2020, and I wanted to make this video for you guys that are just now getting into trading or actually investing. And I want you to understand why most traders lose money. Now, I did make this course. You can find it over at the investingwithchris.com website. It is within the course, the beginner's course. And this is one of the lessons that I want to give this to you in today's video for the fact that I think this is one of the most vital things that you need to be aware of when getting into the venture of investing. Now, a lot of traders hear that most lose money, and hopefully I'm going to explain why. It's not really that 90% of beginners lose money. It's kind of like a skewed statistic based upon they always lose eventually. But the real statistic isn't, or that saying doesn't apply to blowing out your account. You're not going to do that if you do trade smart or invest smart. And I always tell people, don't invest any more than 10% of your entire portfolio into one position or one stock or one strategy. So if you have $100,000, for example, don't use any more than $10,000 to put into a certain stock or a certain strategy. And that's just common sense. So overall, I'm going to go over the objectives as what you're going to learn here, and just basically understand why the traders that do start, they eventually lose money. And that's know the differences between trading and investing. Pretty simple, common sense. Know what penny stocks are and how they work. Know pump and dump strategies and news scams. And then know when to actually trade on what strategies. One of the biggest things out there is the news and how it can inflate the price of a stock. And a lot of people jump onto that, and then once you buy it, it goes down and you're lost in a downward cycle where you can't even get out. And I'm going to explain that here shortly. But the biggest difference in trading versus investing is the amount of time you hold onto that position. Most traders do not hold overnight and definitely do not hold more than 3 to 5 years. However, investors hold on to their positions longer than the 5 years and look for the position to grow over longer periods of time. Obviously, we get into something, we buy low and sell high. We don't just buy it and then hopefully tomorrow it makes us $1 or break even. That's not the goal. We get into it for longer term, and we understand that the flow of the market, the flow of growth is eventually going to turn that $1 into hopefully 2, 3, 4, and 5, so on and so on. These are often called slow growth positions. Certain strategies like capturing dividends, selling options against the position, and so on and so on. Most traders lose money due to the assumptions for a stock's direction rather than knowing things like intrinsic value. And that's one of the most important terms, or one of the most important phrases that you're probably going to hear me always talk about, is find the intrinsic value and how to calculate that. They merely trade off technical analysis instead of fundamental analysis. Now, that's the traders. They merely trade off technical analysis. They look at their chart patterns. They play guessing games rather than diving into the actual fundamentals of the stock, such as the finances, the economical growth, situation, and so on and so on. Now, the definition of the technical analysis is simply this: trading disciplines based off of the evaluations of price trends and patterns within the charts. Technical analysts believe the future price is based off of past price movements and trading patterns. Now, this is why most traders lose money. Fundamental analysis, however, this is the understanding of the company's performance, financial ratios taken from the balance sheet, income statement, and a cash flow statement. And I'm going to show you this, a cheat sheet that I have created for you guys, and I'm going to show you also the in-depth calculations that it does take to find the intrinsic value. And then I'm going to show you a shortcut that I use, a couple resource pages that you're going to find that works the same way, and it takes less time. Now, here's a basic overall business perspective, and I just made up a chart. You have a balance sheet, an income statement, and cash flow statement. Each one of these are highly important and have different reasons to be looked at in different scenarios. Let's get back to the understanding why most traders lose. As we can see, they normally do not pay any attention to the balance sheets, the income statements, or these cash flow statements. They focus on assumptions. And most assumptions come from news. And guess what? Most of that news is bad news and spam news, what I call it. This is often what penny stock, $5 or less price companies resort to in order to draw attention to their stock and quickly pump the stock price up as more interest comes in from traders. After the news, editors or owners of these companies have paid thousands or even millions of dollars to draw the traders in. Traders jump on the bandwagon and begin buying and then shorting. Guys like Tim Sykes are phenomenal short sellers and often know this key area. But do not try to short without knowing what you're doing, because there is unlimited risk to the upside when it comes to shorting stocks. The price can go up and never come back to the price, but in most cases it normally does when it comes to these penny stocks that pump and dump. Again, it's a marketing scam. It's a marketing scheme that these companies do. They pay thousands or millions of dollars to basically draw the interest into these companies, and then you're trying to jump on a trend that's sometimes often too late, and there's not even enough volume to get out of that stock, so you're stuck in it. So just be aware. This is why traders often lose money. Now, here's some of the hardcore facts and statistics that we must understand. 80% of traders lose money over the course of a year, and pay attention to the term I use. I say traders. The average losses are around 36%. 7 out of 10 day traders lose money. Less than 12% made profit on short-term trades. So we have 80% of traders losing money, and then only 12% of those have actually made profit in short-term trades. The average time a stock is listed on the CRSP database between 1926 to 1996 is 7.5 years. So what's that tell us? A lot of stocks or a lot of companies come up in the database, they become publicly listed, and then they get delisted within about 7.5 years. Monthly returns for individual stocks are variable, with deviations being an average of 18.1%. So monthly returns for individual stocks are variable, with the deviations being an average of 18%. Average common loss in stocks in a lifetime is 100%. And what I see is that most stocks that just get listed for the first time, they get inflated in price 20, 30, 40, sometimes 50%, and then all of a sudden they drop. So keep that in mind. Just because a stock comes out in an IPO phase and then it becomes inflated doesn't necessarily mean that it's going to stay at that price. Most of the time, I would say about 90% what I see, maybe even 95%, that stock gets inflated for about a week or two, maybe even a month, and then it starts to fall back down. Out of the 26,000 stocks, only 1,000 have accounted for profits since 1926. And that's some of your large Fortune 500 companies like the Amazon, Apples, Googles, so on and so on. And just 86 of those, which is 1/3 of the 1%, were half of those profits. However, 80% of the largest market cap stocks have outperformed in 10-year periods, and 70% of those have outperformed the market 1-month treasuries. With the growing capability of trading, more and more have failed. Overconfidence in the strategies, taking on more risk. So you stick to one strategy, it starts to make you money, and then guess what? You start piling in more money, and more money, and then all of a sudden you start taking losses and it blows out your account. And then not actually understanding the valuing of stocks, downplaying their losses and leading them to continue and pushing their luck. This is why many and most day traders lose money. That's the cold hard truth when it comes to day trading or trading stocks. It's simply that. If you can grasp the statistics and understand the flow of the markets, understand stock patterns, understand fundamental analysis and reading balance sheets and financial statements, you're going to start learning how the stock flows, when to get in, when to get out, and so on and so on. So this is going to be the last slide, how to keep from being a statistics. Don't risk your low investment for larger profits. Low investments equal low risk. Use the 10-20-50 rule as much as you can. Do not place more than 10% of your entire portfolio in one trade or investment. And when you can take 50% or targeted profit, take it. And do not lose more than 10 to 20% of your position when it starts to see a loss. I want to reiterate this or go back on that. When you get into investing in stock options, most of the time you will see a loss, either right off the bat or in a few days. But if you understand how options work, you're going to build the confidence, not too much, and you're going to stay in that, and then you're going to see a profit if you use the statistics when it comes to stock options. And as always, diversify, such as dividend paying, bonds, options, and stocks, etc. Do not go with recommendations or jump on trends. Learn, master, and repeat. Learn what works for you and stick with that. Research the stocks and do not go with personal perspectives. Like if you own Nike shoes, then you go and buy that stock. Understand what goes on the inside of the market and educate yourself and understand other strategies. Now, with that being said, I'm going to jump into this Kodak. I know about 2 weeks ago it was the talk of the town. Everybody was jumping into it, and we can see what happened. Now let's look at the history of this. Back from 5 years ago, it has done nothing but fall, and then it jumped to $60. And that's because of some bullshit news. I'm not going to tell you guys that always the news comes out and you should jump on the trend. I'm probably always going to tell you don't do that. And that's what a lot of people did. And as you can see, it fell right back down to $6.95 and probably going to continue down about $3 to $2. And then that's going to be its flat line. And then you're going to see some more news come out to try to pump and dump. And that's constantly what happens to these crappy stocks. And I'm not saying Kodak is not a good stock. I mean, we can take a look at its financials. But in the end of the day, don't get hyped up on the news. Get into it and blow out your account when you can see what just happened. If you bought it up here in the 40 and 50, you're going to be holding on to this quite a long time, or even you're just going to sell out and get out for a loss. Here it is. A class action lawsuit on behalf of shareholders of Wins, Kodak, and this, I'm not quite sure, Genius maybe. I'm on a GNUS stock. Let me see what this is. Yeah, Genius Brands International. All right, guys. So right here, Kodak's being today, the 24th. Securities litigation law firm, the Gross Law Firm, issues the following notice on behalf of shareholders in the following publicly traded companies. Kodak is one of them. You can read this article, figure out why, but I'd probably say it's because of this BS News article. I think they were talking about they found a COVID cure or going to get in pharmaceutical. Obviously, that's not what Kodak is. So just keep track of the news. I don't want you to solely use that to jump in. As you can see how it burned a lot of people. But do follow the good news that does exist. Let me take a look at this. This is going to give you the cheat sheet that I talked about. You can see price to book value, PE ratios, understanding a balance sheet, what all the terms are, the discount cheat sheet, basically breaking down a value of a $5 bill and what it's going to resort to or what it's going to cost later on in life, all the way down to the year 2119. I also, in a course that I have on my website, that Investing with Chris, I talked about what the net present value or inflation risk when it comes to athlete contracts and how those work, why the price is often discounted right now versus if you was to take a contracted payment over a course of years, and why that happens for athletes or anything we do as lump sums, etc. The balance sheet template and forecasting. Now this is why it takes a lot of formulations or valuations when trying to figure out the intrinsic value of a company, learning what the actual share price should be over the course of time, and how difficult it is for a new beginner to understand this. But I also gave you a comparison to Discover CI, a website. It's a free website that I found where you can actually find it based upon things like its current growth rate, its weighted cost of capital, risk-free rates, tax rate, and etc. It takes all that in to play, and it gives you the intrinsic value and also your downside risk or your upside risk. And then also a Guru Focus website that I use, you can see it too, how it computes or formulates that intrinsic value or discounted based upon a discounted cash flow statement or whatever it uses. You can use, I think it does give different options what to use. I always use a discounted cash flow, and then this Discover CI uses a little bit more projection inputs, as you can see. And the last price for Apple was at $3.23. I can't remember the date. I thought I gave it somewhere. And then what the actual per share value should be and what you should be paying. And then I also have a calculating bonds cheat sheet here. I'll give this link to you guys that find this video. But anyways, I hope that helps. Let me take one other Kodak for example. Let's look at its intrinsic value or its valuation here. And a lot of you guys jumped onto that. I hope you didn't. But yeah, it's only giving us a 25-cent intrinsic value, actually a negative 25 cents. So if we bought it today, we have a 2,875 downside risk. And that's just based upon what Kodak is currently doing, such as its finances and all that. So I would stay away from Kodak. DiscoverCI.com is the website. If you find yourself trying to search for a stock and it doesn't allow you the stock valuation, that means either the stock financials are too new, and you just obviously there's no data to go off of that. So try resorting to Guru Focus. GuruFocus.com and searching for your stock. Has a lot of good inputs. Has a valuation rank, profitability rank, and financial strength. Gives you a quick chart to kind of look at. Next earnings date gives you that. 30-year financials. Go over here to the discounted cash flow. Based upon the fair value and the defaults. Gives you a growth stage and then a terminal stage. If you don't know what those two are, I do talk about that in my course. But anyways, it gives a fair value of negative 51. So Kodak here, Discover CI gives us negative 25 cents, and Guru Focus is saying negative 51. So guess what? I'm going to stay away from that. So I hope this video helped you guys. DiscoverCI.com, Guru Focus, and just how traders often lose money. Comment down below what video you want to see next, and as always, I'll see you next time.